Hello. Hiya.
Hi, morning, Michael.
Hey, how you doing, George? Uh,
Good.
thank, thank you for the reminder to put the link there. It's really kind of you. Thank you very much.
Welcome.
Um, yeah, I'll just give another couple of minutes for people to kind of come in a little bit. Just grab my coffee. How are you doing, George? How's life?
I'm good. I'm sorry what didn't make it
That's fine. That's fine.
last week. I was so embarrassed. I had said gave that big talk about Zim, and the very next day it was like down like 9%. So I was like, I'm so embarrassed.
No, no, man. That's the game. That's the game, right?
Yeah.
Yeah, man. That's the game, man. You can't think about that. You can't put yourself in that position. Um, there's always, a reason to be frightful, in
Yep.
investing. There's always a concern. It's always something, some distraction. Oh, like, oh, this, that, the other, and some headline somewhere. Um, yeah, I don't think that it's difficult. Investing is really difficult. And knowing when is the information important and not, that's really, really important to kind of have some view on it. And that's why, personally, I don't really follow too much what happens outside of the quarterly results. um Sometimes the share price starts moving down on the approach to quarterly results, and then the results come out and they were bad. And that's, I'll take that. That's fine. It was my mistake, whatever. But it's really difficult to try and read into these tea leaves and have some kind of view of, oh, does someone know something?
Right.
And yeah, I feel that more often than not, even when the bad news does come out in the earnings result, the market gets some clarity, and a portion of that uncertainty gets lifted. And really, what the market is trying always to do is to have some kind of price in the expectation of the future profitability of the business. The market is trying to figure out, okay, yeah, that is a bit of bad news, but I can kind of more or less quantify how big an impact it is. And that then can lead to, a stabilization of the share price. And once there's that stabilization, people get re-interested again. And sometimes that stabilization, happens really quickly, like in a few weeks. Sometimes it takes longer. But, forcing yourself to have a view on the share price movement all the time is a really tricky business. And a lot of people like to believe that they have some more insights than the market. But, and although, I know we spoke about this before, there are many different ways to uh, shed the skin of a cat. But ultimately, very few people can do it repeatedly for a long period of time. And that's really, the reason why Buffett is like the messiah is not that his results are particularly tremendous out of disproportionality. There are other investors that are also done really, really well. But why Buffett is the messiah is that he's done it for such a long period of time. And that is difficult to continuously adjust to new ideas. I'm not the best Buffetologist going, but I try to think about this, right? So Buffett was already an investor in the 50s. In the 50s, like none of this technology existed, like none of this. And he had to like continuously learn like new ideas. And that's really difficult. I speak to a lot of investors, and people get dogmatic on their points of view. And this cuts both ways. For example, the share price is up, they buy the shares, the share price comes down, and they're like, oh, now it's even more in the price. Like, people get feverish about it. And on the other side of the equation is like, which I'm going to talk about, I'll kind of use this as a segue, is when the market is agreeing with you, and then, you know, okay, the market agrees with me, the share price is going higher, and for a while, you're kind of lulled into a sense of complacency because there's no hard questions being asked, you know? The share price is going up, everyone's singing, everyone's dancing, and at those periods of time, you feel like you're smart, and that's a real big problem, you know? Someone once said this to me, and it stayed with me, that are you coming to the market to grow your returns, or are you coming to the market to feel smart, to feel like you know something more than somebody else? And that's a brutal game, you know? And I kind of believe with the passage of time that, and I've addressed this in previous calls, that the investment thesis needs to be in your face. Like, it doesn't, you know, once you start kind of saying, oh, you've thought about this and consider that and all these different things, it just becomes a waste of energy. And since we've kind of touched on Buffett, on the Financial Times, there was a Financial Times article on the eve of the Berkshire Halfway meeting. It was early May, and it says that since 2010, Buffett has sold out of 63 positions that he had, fully sold out. That's not trimming, that's fully sold out out of 63 positions, with each position having an average of 4 years and 3 months. So that's more than a decade, obviously, you know, going back to 2010. So it's a, you know, it's a reasonable period of time. And it shows that even Buffett, at the size that he's at, he himself doesn't have a view on this buy and hold forever. And I feel, you know, when we were in the COVID period, people, understandably, me too, kind of got lulled, got kind of confused slightly into believing that there was like this secular growth in tech, for example. And everything was working, you know, it was very, very steady growth. It was like so easy, man. You kind of, it was really, really easy. And at that period of time, it was like everything is like a secular growth story. Everything was growing, and IT was growing, and software was growing, and everyone was singing and dancing. And why those stocks get such a high premium is that subscription model. And it makes sense, right? It really makes sense. It's not a difficult thing. And that's the problem as well. Because it's so simple, it kind of gets carried away. The narrative gets carried away. And it starts off with a grain of truth. So, you know, the cycles that last, they vary. And sometimes they're short. Certain businesses have very short business cycles, like a year or two, they have like a little flash in the pan. And other cycles are slightly longer. And the other side of the coin is that certain businesses are always on sale, like they're always cheap, like always like there's this one called Build a Bear. So it's a retailer in the US. Maybe George, you know about this one. Build a Bear. This type of business, man, is really cheap, like really, really cheap. But it's always cheap because the market has been through these cycles, and they kind of knows, okay, you'll have a good period and it's going to go for a bad period. And it's just always on sale. And then you have other side of the businesses, for example, CrowdStrike, that seemingly never really go on sale. They're just really, really expensive, really, really expensive the whole period of time. And you kind of end up, you know, trying to be, oh, I'll pay a high price in the hope that, you know, I can get out at an even higher price. So it's really complicated to have a view of, you know, when to sell. And what I've tried to think about is this: two things. Number one, that most investors would massively prefer to lock in a 20% gain rather than face the discomfort of taking that 20% loss off the table. Because when it's the loss, it's a paper loss, hasn't been crystallized, and it's like, oh, you know, it's going to come back. and hopefully it does, but it may not, right? Whereas the company that has a gain is like that pressing need. Oh, it's overextended, or some other kind of words that people use similar to that to that effect. But it's just that the business is doing quite well, and you can carry on with that share price for a while. So here I'm thinking, for example, of hymns. There's so, like, you highlighted hymns today in the chat, so I was kind of that's at the top of my mind. What do I do here, Michael? Like, the business, finally, I've been pushing this company for so damn long, and it's been a really long number of years, and now it's like, okay, it's working finally. But I've got everything out of it. Like, the multiples expanded. Everyone is singing. I look on Twitter, like everyone is singing like hymns, people are just hands in the air. And man, I know that it could continue to go. You're never going to get out of the top, right? So you can either sell when everyone is like singing and dancing, and you don't need a stop loss in that period because you're selling at the highest point that is traded at for the past, let's say, 6 months or a year. You don't need a stop loss because you're selling right into that strength. It's okay. You don't need a stop loss. It's maximum price you're going to get for it, sold. Or you can sell on the way down and you feel gutted, But even worse, more important to me than quote unquote feeling gutted, feeling frustrated about selling on the way down, is that you lost time, right? Because it's gone on the way up, it starts losing momentum, it comes down, 6 months have passed. And those 6 months, you could deploy elsewhere that capital. You wouldn't feel great at first, because whenever you kind of go to a new investment, it's kind of new, and it's untested. It takes time for the market to kind of see things from your point of view, and it doesn't feel as exciting. And I'll give you another example of something that I failed with. So I recommended last year Broadcom, and Broadcom was my kind of anti Nvidia trade. And for the 11 months that I was recommending it, it was up 43%, massively underperforming Nvidia, massively. But I couldn't invest in hindsight. And now the results came out last Thursday, and the share price is like bang, off to the races. But it's okay, man. You're not gonna get out of the top of the stock. And you have to have that in your point of view. You have to think about that, because with Broadcom or with HIMS, which is something that I own at the moment, the multiples are already really, it's piping hot, and you have to think about that a lot. You have to think about preservation of capital. You have to you have certain positions in the portfolio, and some are having their moment in the sunshine, and you have to be mindful. And for example, I look at this earnings call when the market is hot, like it was in January. There was quite a few people on the call, and when the market is kind of in that risk off moment, it kind of there's not that much enthusiasm. But I know from experience that it's the moments of least enthusiasm that you have to be most alert with the market. It's so important to be very mindful. And when I look at something that the market is not particularly enthusiastic about, it's important to say, okay, are the fundamentals still continuing? So in my mind, I just wrote about before, Sentinel-1, the share price is petered out, it's kind of dead. But the fundamentals, which for me are important, namely the prospects of free cash flow coming next year, the business is doing really, really well. So this is my North Star. Other people have different North Stars, but I think a lot about that. Are the fundamentals still okay? And if the share price hasn't really, hasn't gained any traction for a little while, what's happened is that the multiple is compressed. And multiples compress, and at some point they expand. And I've seen that many times. I saw that with Uplovin. Obviously, we referred to HIMS many times already. I saw that with HIMS. That multiple, it messes with your mind. So you have to really, really kind of thinking a lot about that. So I don't have a lot more that I want to go on. If anyone wants to ask any questions, this would be a good time for you to ask anything you'd like to know about. Yeah, if anyone wants to ask any questions. Okay. If nobody wants to ask anything, I don't have a lot more to say. I'm very passionate. I don't know if it's because, you know, being the summer and stuff like that, but I'm really motivated. I find myself so obsessed with trying to drive the performance of the portfolio, because I cannot stop thinking about what the performance is going to be at Christmas, because I've been telling people throughout the year that I find it that I needed to deliver to people 15% return. I was like, I need to do this. I need to do this, you know? And I asked people to trust me in my vision. And we're kind of approaching 6 months, and we've done about 30%. Obviously, you know, 6 months, there is still another 6 months until at the end of 2024, and it can go down, you know, and it can go up. But I'm very mindful that is these periods when everyone's kind of like absent-minded, that's when the performance really starts to matter. So I'm really excited. I'm really, you know, two parts of my mind. So one part of my mind says, okay, you know, in 2025, I think I should have a more trimmed portfolios, maybe slightly more concentrated, with let's say 16 to 18 positions rather than 20. But on the other side of the equation, you know, sometimes these stocks that are like dogs, like Enovix, man, like you have them in the portfolio and they're like dogs, man, like proper dogs. But then they start coming back, and you're like, oh, you know, that thing is still alive, and you're like, oh, you know. But if I was more brutal and more kind of concentrated, the portfolio would also be a lot more volatile. And you know, as I'm providing a service to people, and I recognize that small caps is brutal. It's a brutal game. It's really volatile, the stocks. So if I had a more concentrated portfolio, I would have higher performance, but it'd be a more volatile ride. And you know, I need to take people with me on my journey. So yeah, you could have a higher return, but if I'm taking fewer people, you know, what's the point? So yeah, I'm kind of speaking out loud, kind of something that I'm kind of in the back of my mind toying with. Yeah, it's difficult, man. Okay. If anyone wants to ask any questions, I'll ask you again. Otherwise, I'll just kind of wrap it up here today.
Just want to thank you for the article on Sentinel-1. I think, you know, maybe things get in favor and out of favor, but to be reminded, hey, it's still good. It's nice to have a confidence check like that. Thank you.
Okay, thank you so much. Thanks, George. Really appreciate that. Have a nice morning, and I'll catch everyone next week, hopefully. Thank you. Bye-bye.
Thank you.
Thank you so much. Bye-bye.